Global debt has reached levels never recorded in peacetime history, yet global stock markets continue to hover near record highs. This contradiction sits at the center of the modern financial system, quietly challenging the assumption that rising debt and rising prosperity can coexist forever. Central banks insist inflation is under control while simultaneously holding trillions of dollars in government bonds created during emergency interventions. Stability is declared even as the very tools used to preserve it remain permanently engaged. Household purchasing power has weakened across advanced economies, yet official economic data often reports resilience and recovery. The gap between lived economic reality and reported stability has become one of the defining signals of systemic stress. Equity markets have surged during periods when real wages failed to keep pace with inflation. Asset prices have floated upward while the economic foundation beneath them has slowly eroded. Government deficits continue to expand during periods labeled as economic growth rather than recession. Borrowing has become a permanent feature of governance instead of a temporary response to crisis. Bond markets have repeatedly flashed warning signals through inverted yield curves and rising long-term risk premiums. These signals have often been dismissed as outdated indicators in a supposedly new financial era. Banking systems are routinely described as well-capitalized shortly after requiring emergency liquidity support. Survival is reframed as strength, and rescue is rebranded as resilience. National currencies can appear strong on foreign exchange markets while steadily losing domestic purchasing power. The exchange rate masks the silent tax imposed through inflation. Economic experts increasingly disagree not on opinions, but on basic forecasts once considered reliable. When models conflict simultaneously, it suggests the system itself is changing faster than the tools used to measure it. History shows that when contradictions like these align, they do not resolve gently. They mark the early phase of a pattern that has preceded every major financial reckoning. Modern economies run on credit the way engines run on fuel, converting future promises into present growth. When credit expands smoothly, it creates the illusion of prosperity without immediate cost. Governments favor borrowing because it delays political consequences while delivering immediate spending power. Taxation is visible and unpopular, while debt is abstract and postponed. As debt accumulates, financial markets become dependent on constant refinancing rather than repayment. Growth shifts from productivity to leverage, quietly changing the economy's foundation. Banks do not merely transfer savings to borrowers, but multiply credit through lending mechanisms backed by confidence. This amplification accelerates booms and magnifies busts when conditions reverse. Central banks intervene to smooth downturns by lowering interest rates and injecting liquidity. These actions stabilize markets in the short term while increasing long-term dependence. Low interest rates reduce the cost of borrowing but also distort risk perception. Investors begin to treat leverage as safe because losses appear distant and unlikely. Asset prices rise faster than wages because newly created money enters financial markets first. This creates wealth effects without corresponding increases in real economic output. Inflation does not always appear immediately in consumer prices. It often accumulates quietly in housing, equities, and bonds before spilling into everyday costs. As debt grows relative to income, each additional unit of borrowing produces less growth. The economy becomes saturated, requiring larger interventions for smaller results. Eventually, stimulus stops accelerating growth and merely prevents contraction. At that point, policy tools lose effectiveness without policymakers admitting it. Money functions because people believe it will retain value tomorrow. Once that belief weakens, no legal framework can fully restore it. Confidence erodes gradually through repeated interventions that contradict official assurances. Each rescue teaches markets that instability is structural, not temporary. Capital seeks safety when trust declines, flowing away from risk regardless of incentives. This movement is rational, not emotional, despite how it is often described. To prevent capital flight, authorities suppress yields and manage expectations. Risk is not eliminated, only hidden and mispriced. Inflation feeds on itself when wages, prices, and borrowing rise together. Debt then becomes both the cause of inflation and the reason it cannot be reversed easily. Political systems delay adjustment because pain is immediate while benefits are uncertain. Economic realities continue accumulating regardless of electoral cycles. Financial crises appear sudden only to those watching prices instead of balance sheets. By the time markets react, the damage has already occurred. Reserve currencies can postpone consequences by exporting inflation abroad. This privilege delays reckoning but increases the scale when it arrives. Across centuries, the same pattern repeats under different names and technologies. The tools change, but the sequence remains remarkably consistent. To understand what comes next, history offers documented examples where this pattern reached its breaking point. The most revealing cases are not ancient but modern and meticulously recorded. In 1919, Germany emerged from World War I burdened by enormous state debt and economic dislocation. The collapse of imperial governance left the new Weimar Republic financially fragile and politically constrained. The Treaty of Versailles in 1919 imposed reparations totaling 132 billion gold marks, an amount far exceeding Germany's productive capacity. These obligations were denominated in foreign currency and gold, increasing pressure on the domestic money supply. Unable to raise sufficient taxes or borrow externally at sustainable rates, the government turned to monetary financing. The Reichsbank began expanding the money supply to meet fiscal obligations. Between 1920 and 1921, the quantity of paper marks in circulation increased rapidly. Prices began rising not from shortages, but from currency dilution. In mid-1921, foreign exchange markets lost confidence in the German mark. The currency began falling sharply against the US dollar and British pound. By January 1922, inflation had reached approximately 50% per month. Wages lagged behind prices, eroding purchasing power across the population. The Reichsbank continued printing money to stabilize employment and meet debt payments. Each intervention reduced confidence further, creating a self-reinforcing cycle. By the summer of 1923, the exchange rate collapsed from 4.2 marks per dollar in 1914 to over 4.2 trillion marks per dollar. Money ceased functioning as a reliable unit of account. Prices doubled within days, sometimes within hours. Households spent wages immediately before they lost value. Banks became conduits for currency destruction rather than financial stability. Savings accumulated over decades were wiped out in months. The middle class suffered the greatest losses as fixed incomes were destroyed by inflation. Social trust fractured as contracts became meaningless. Businesses raised prices continuously, anticipating further devaluation. This behavior accelerated inflation rather than responding to it. Tax revenues collapsed in real terms despite nominal increases. Government finances deteriorated faster as inflation rose. The crisis peaked in November 1923 when economic transactions began reverting to barter. Currency had lost its function as a store of value. Stabilization came only after monetary reform ended direct financing of government deficits. The Rentenmark was introduced with strict issuance limits. Fiscal discipline was restored through spending cuts and tax reforms. Confidence returned only after monetary credibility was reestablished. Short-term stability followed, but long-term damage remained embedded in society. Wealth redistribution had permanently altered economic structures. The Weimar collapse was not an isolated failure of leadership. It was the result of policy choices constrained by debt, politics, and delayed adjustment. Similar patterns later emerged in Argentina during the 1980s and Zimbabwe in the 2000s. Each case followed the same sequence of debt expansion, monetary financing, and currency collapse. Warning signals were visible long before hyperinflation occurred. They were dismissed as temporary distortions rather than systemic failures. The lesson is not that modern economies will repeat identical outcomes. The lesson is that monetary stress follows predictable paths once trust erodes. To understand the present, the past provides a measured framework rather than a dramatic prophecy. The same pressures now exist on a larger and more complex scale. Global debt surpassed $300 trillion by the early 2020s, exceeding 3 times total world economic output. This expansion occurred during a period officially described as recovery rather than emergency. In the United States, federal debt rose from approximately $9 trillion in 2008 to over $33 trillion by 2023. This increase was driven by crisis response, structural deficits, and long-term entitlement obligations. The 2008 financial crisis marked a turning point in monetary policy. Central banks shifted from interest rate management to large-scale asset purchases. Quantitative easing expanded central bank balance sheets by trillions of dollars. These interventions were initially described as temporary and reversible. During the COVID-19 pandemic, fiscal and monetary expansion reached unprecedented levels. Governments financed stimulus through direct bond issuance absorbed by central banks. Between 2020 and 2022, the U.S. Federal Reserve balance sheet more than doubled. Similar expansions occurred at the European Central Bank and Bank of Japan. Low interest rates reduced debt servicing costs and encouraged further borrowing. Risk assets surged as capital searched for yield. Housing prices rose sharply across advanced economies. This appreciation outpaced income growth and productivity gains. Inflation surged in 2021 and 2022, reaching over 9% in the United States. Central banks responded with rapid interest rate increases. These rate hikes exposed vulnerabilities built during years of cheap credit. Debt servicing costs rose across governments, households, and corporations. In 2023, several regional U.S. banks failed after asset values declined. Emergency lending facilities were reintroduced to prevent broader contagion. Commercial real estate markets showed rising default risks. Office vacancies increased as refinancing became more expensive. Sovereign bond markets also reflected stress through rising yields. Governments faced higher costs to roll over existing debt. Despite higher interest rates, deficits continued expanding. Fiscal restraint remained politically constrained. Currency markets began reflecting geopolitical fragmentation. Some nations sought alternatives to dollar-denominated trade. The US dollar retained reserve currency status due to liquidity and trust. This position allows greater borrowing without immediate consequences. Reserve currency privilege does not eliminate debt limits. It postpones adjustment by spreading costs globally. Confidence, not accounting, sustains modern monetary systems. Once confidence weakens, adjustment accelerates rapidly. Structural deficits differ from cyclical downturn spending. Many advanced economies now operate with permanent fiscal gaps. Aging populations increase pension and healthcare obligations. These pressures reduce fiscal flexibility over time. Policy options narrow as debt accumulates. Each response creates future constraints. Markets continue pricing stability despite mounting imbalances. Optimism persists, while intervention remains credible. History shows that credibility erodes gradually before breaking suddenly. Financial calm often precedes structural adjustment. The present moment mirrors earlier stages of documented debt cycles. The difference lies in scale, complexity, and global integration. Understanding where this leads requires examining consequences rather than predictions. The next phase follows arithmetic rather than ideology. When debt reaches levels that cannot be repaid through growth or taxation, inflation becomes a policy outcome rather than a failure. It is the least visible method of reducing real debt burdens. Historically, governments respond to excessive debt through financial repression. Interest rates are held below inflation, quietly transferring costs to savers. This process erodes the real value of savings without explicit default. Wealth is redistributed gradually through declining purchasing power. Currency volatility becomes a persistent feature rather than a temporary shock. Exchange rates reflect uncertainty about long-term fiscal discipline. Asset prices experience repeated cycles of instability. Markets swing between confidence in intervention and fear of loss. Banking systems consolidate as weaker institutions fail or are absorbed. Concentration increases systemic importance while reducing competition. Government intervention expands as private balance sheets weaken. The boundary between public and private risk becomes increasingly blurred. Economic mobility declines when inflation outpaces wages. Younger and lower-income households bear disproportionate costs. In past debt cycles, capital controls emerged when currency pressure intensified. These measures were framed as stabilization tools rather than restrictions. Debt restructuring becomes more likely when servicing costs crowd out essential spending. Restructuring does not require default to impose losses. Because modern finance is globally interconnected, stress spreads across borders quickly. Trade flows and investment decisions amplify domestic imbalances. Currency and trade disputes intensify as nations protect domestic stability. Economic friction replaces cooperation under stress. Trust in institutions declines when repeated assurances conflict with lived experience. Credibility, once lost, is difficult to rebuild. These outcomes rarely arrive all at once. Adjustment unfolds through years of incremental change punctuated by sudden market repricing. The future is shaped less by surprise than by delayed recognition. What matters most is not the trigger, but the accumulated imbalance behind it. Market crashes are not singular events, but the visible resolution of long-running imbalances. Prices adjust only after financial structures have already weakened. Periods of apparent stability often coincide with the greatest accumulation of hidden risk. Confidence peaks when intervention appears most effective. Economic history does not repeat through identical outcomes, but through familiar sequences. Debt, currency stress, and policy delay form a recognizable pattern. Modern financial systems are more complex, not more immune. Complexity spreads risk rather than eliminating it. Understanding economics requires tracking balance sheets, not headlines. The most important signals emerge long before markets react. Experts are often shocked, not because data is absent, but because prevailing narratives obscure it. Models fail when assumptions persist beyond their usefulness. The next market adjustment will not violate historical precedent. It will confirm it through scale rather than novelty. What matters is not predicting dates or triggers. What matters is recognizing the pattern before confidence gives way to arithmetic.